This isn't a gold crash, it's a deliberate flush. And the only honest signal right now isn't the screaming red candle. It's what happens the moment you try to turn that screen price into actual metal. Because while your quote feed is flashing a neat little dip, down $8 into the $2,140 area, physical desks are doing something that should immediately make you suspicious. They're not racing to dump inventory, they're widening, delaying, quoting call for availability, or simply choosing not to commit size at a price they don't trust. And that's where the real pressure starts. Because if the paper market can push price down with one hard shove, but the physical market won't follow, then the move you're watching isn't a verdict on gold, it's a stress test on the plumbing. And later in this video, I'm going to give you the concrete payoff, the levels that matter, the next tweak checklist that tells you whether this was a shakeout or the start of something nastier, and the one hidden metric that reveals who's actually in control when the headlines get loud. First, let's get brutally clear about what you just saw. An $8 hit on gold can look like nothing until you remember what it's designed to do. It's not meant to bankrupt long-term holders. It's meant to trigger the fragile layer. Tight stops, leveraged longs, systematic de-risking, and the I can't take this crowd who bought late and can't tolerate noise. That's not drama, that's mechanics. Liquidity in gold futures can thin out in specific windows. Bid stacks disappear. A market order becomes a broom, and the price doesn't have to fall far to create a cascade. Because the cascade isn't about distance. It's about who gets forced to act, but that's not the part that matters. The part that matters is what the other side is forced to do once the flush is complete. Before we go deeper, quick reality check so you don't get trapped by bad data. If you're seeing $2,840 on your screen, make sure you know what you're actually looking at, which contract month, which venue, and whether your feed is delayed, whether it's quoting in a different unit, or whether it's a synthetic cross. Major benchmark of spot pricing in early January 2026 has been trading far above that level on many mainstream feeds, so a $2,140 print can be a different reference point altogether. And that's important because the exact number is less important than the behavior. The same microstructure rules apply whether the screen says $2,840 or $4,480. The move is the move. The mechanic is the mechanic. And the setup you're trading is the same setup. Keep that in mind because the next detail flips the whole story. Now, about that phrase that's lighting people up, physical dealers refuse to sell. If you're new, that can sound like a conspiracy. If you've lived in this market, you know it's usually something more boring and more powerful than a conspiracy. Replacement risk. Dealers are not paid to be heroes. They are paid to manage inventory, hedge exposure, and survive volatility without getting run over. When the paper price drops fast, a physical dealer has to ask one question before they sell you metal. Can I replace this metal at the same effective cost tomorrow? Not the same screen price. The same effective cost after premiums, after shipping, after fabrication, after restocking lead times, after the risk that the wholesale pipeline dries up for a week. If they can't confidently replace, they don't sell in the way you want them to. They ration, they widen, they stall, they cap size. And that behavior is a signal, not a moral statement. Because if physical sellers are reluctant during a paper drop, it means the drop is not being validated by the supply chain. And if the supply chain doesn't validate it, the paper move has a habit of snapping back when forced selling ends. But not always. And that's why we're going to build a proof stack, not a vibe. Here's the hidden detail that most people miss, and it changes how you interpret everything you're seeing. Gold can look weak on the screen while the delivery market quietly tightens, because paper can be sold infinitely faster than metal can move. Futures can print 10,000 contracts in seconds. Physical supply chains can't print bars. They refine, they assay, they ship. They allocate vault space, they clear payment, they arrange insurance, they handle compliance, they manage fabrication capacity. Those are real-world constraints. So when you see a sharp dip in paper price alongside dealer reluctance or rising premiums, you're not watching gold crashing. You're watching a disconnect between price discovery and deliverability. And that disconnect is where serious moves are born. Because if enough participants decide they don't trust the paper price, they start demanding terms, better spreads, nearer delivery, higher premiums, tighter conditions. And that pressure expresses itself in the one place the headline price can't easily hide. The spreads and the curve. Let's simplify this without dumbing it down. The gold price most retail investors stare at is predominantly a derivatives price. Futures and large OTC flows lead the dance. Physical dealers are dancing to a different song. They're not marking to your candle. They're marking to their ability to source, hedge, and deliver product while managing the risk that the market gaps against them overnight. When they quote you a price on a bar or a coin, you're not just buying gold. You're buying conversion from wholesale form to retail form, plus the dealer's risk buffer, plus liquidity in the physical world. That's why you can't buy at spot. That's why premiums exist. And that's why premiums change fastest when the market's under stress. Because premiums are the market's way of saying, you can have it, but you can't have it cheap. And you can't have it now, and you can't have size without a conversation. And that's not a conspiracy. That's the supply chain vetoing the paper narrative. Now watch what happens during these flushes. The paper price dips, and everyone thinks, oh, demand must be weak. But physical desks don't see weak demand. They see a stampede of two kinds of buyers. The bargain hunters who have been waiting for a dip, and the nervous buyers who don't want to be locked out if the next move is higher. That second group is the one that changes the market, because it changes dealer behavior. Dealers don't just sell into nervous demand, they protect themselves against it, they raise effective prices, they shorten quote windows, they demand payment certainty, they slow walk delivery promises. And if enough desks do that at once, the physical market becomes sticky. The paper can dip, but the physical doesn't clear, and then something subtle happens. Arbitrage starts sniffing around and the spreads start screaming. But that's not the part that matters. The next part is what forces the paper market to respect the physical again. This is where term structure comes in, and if you ignore it, you're trading blind. Gold doesn't just have a price, it has a curve. Different delivery months trade at different levels because of financing costs, storage, convenience yield, and real-world availability. In a calm market, that curve behaves politely. In a stressed market, it starts talking back. If nearby contracts get unusually firm relative to later months, if the front end tightens, if spreads behave oddly, that's the market whispering that metal now is more valuable than metal later. Sometimes you all hear people throw around words like backwardation and contango like it's magic. It's not magic. It's incentives. Contango means future delivery costs more than spot, often because carrying costs exist. Backwardation means spot or near-term delivery is expensive relative to the future, often because something is tight right now. In gold, sustained backwardation is rarer than in energy because gold is storable and widely held, but you don't need a textbook condition to get a signal. You just need unusual behavior. An unusual behavior in the curve during a paper flush is a neon sign that physical tightness is pressing on price discovery, and that's where the real pressure starts. Now let's address the trap people fall into with inventories, because this is the second hidden lever. You'll hear, there's plenty of gold in warehouses. Sure, but which gold? Total reported stocks are not the same thing as deliverable supply. Warehouses often categorize metal in ways that matter. There's metal that is eligible to be delivered. There's metal that is registered or specifically earmarked for delivery against futures. There's metal that exists, but is owned, allocated, or otherwise not for sale at the moment. There is metal that technically sits somewhere but is not practically available without a price that forces it out. So when someone points to a big inventory number and says, no shortage, you should immediately ask, how much of that is actually going to meet delivery if paper shorts get pressured? Because in a stress moment, the only inventory that matters is the inventory willing to move at the posted price. And that inventory can be a lot smaller than the headline number. That's why you can get physical tightness, even in a world with plenty of total gold. This isn't about apocalypse, it's about float. The float is what sets the marginal price. And the float can dry up fast when people decide they don't need to sell. But that's not the part that matters. The part that matters is why this is happening now, not 6 weeks ago. Here's your why now trigger, and it's not mystical, it's the calendar. Specifically, this is one of those windows where mechanical flows hit the market on schedule. Annual commodity index rebalancing can force billions in futures, buying or selling over a known period. That means price action can look fundamental, even when it's just mandated. Funds tracking major indices aren't making a discretionary call like, gold is overvalued, sell. They're executing instructions. Reduce weight here, increase weight there, roll here, rebalance there. That flow doesn't care about your chart pattern. It doesn't care about your feelings. It cares about its benchmark and its deadline. So what do smart operators do when they know a big mechanical sell program is coming? They front run the liquidity. They lean on price into thin pockets. They try to shake out weak longs before they have to absorb size. And if they can trigger stops and margin calls, even better, because forced selling gives them inventory at better prices. That's not a conspiracy. It's market structure. And it's exactly why a small, sharp dip can happen for no reason on the same week. Everyone is staring at the same calendar. The calendar is the catalyst. But that's not the part that matters. The part that matters is whether the market can absorb the flow without breaking. Now let's add the macro layer, because gold doesn't trade in a vacuum even when the physical is tight. Gold is hypersensitive to the dollar impulse and real rate expectations in the short term. If the dollar pops, if yields nudge higher, if the market suddenly prices fewer rate cuts, gold can get hit, sometimes brutally, even if the medium-term thesis remains intact. Why? Because leverage doesn't have beliefs. Leverage has maintenance margin. When macro jolts hit, the first reaction in a crowded trade is de-risking. Funds reduce gross exposure. Risk parity models rebalance. CTA systems respond to trend breaks. Dealers adjust hedges. And if gold has been strong, it becomes a source of liquidity. Sell the winner to meet risk limits elsewhere. That's how you get gold is down on safe haven headlines days. The headline is for humans. The tape is for positioning. The next detail is what flips the whole setup, how options and dealer hedging can amplify moves around key strikes. Here's the mechanic. Most people never learn, and it matters most during fast moves. Delta hedging and gamma. Options dealers who sell calls and puts manage their risk by hedging the underlying, often with futures. If price approaches a heavy strike area, the dealer's hedging needs change quickly. In high gamma zones, small moves and price force larger hedging adjustments. That can create reflexivity. Price moves a bit, dealers hedge, hedging moves price more, which forces more hedging. It can happen on the way up and on the way down. Now tie that to a calendar week with forced index flows and thin liquidity windows, and you get a market that can look irrational. A small initial shove can snowball because hedgers become price takers, and the moment the shove ends, the same mechanic can reverse. That's why you can see a sharp dip into a level, like 240, and then a snapback that looks like a V, not because buyers got excited, because hedgers got forced, but that's not the part that matters. The part that matters is whether physical signals confirm the snapback or contradict it. So let's build the proof stack you can actually use right now without guessing and without falling in love with a story. Proof point 1 is the curve and the spreads. If the front end tightens during a dip, if nearby contracts don't cheapen as much as they should, or if spreads imply urgency for near-term delivery, that's a physical tightness tell. Proof point 2 is dealer behavior, premiums, availability, delivery times, and whether the refuse to sell chatter is localized or widespread. One shop being stubborn is noise. Multiple regions showing sticky premiums while paper dips is signal. Proof point 3 is inventories, but viewed correctly. Not total, but deliverable float and trend. Are deliverable categories shrinking? Are withdrawals rising? Is metal moving out of easily deliverable status? Proof point 4 is institutional flow behavior. ETF demand and central bank accumulation can matter as background support, but more importantly, watch whether dips are met with stabilization rather than waterfall. Proof point 5 is macro impulse. Is this dip aligned with a dollar spike and a rate repricing, or is it happening in a calm macro tape? A dip with a macro shock is explainable. A dip without one suggests flow mechanics. Proof point 6 is cross-market comparison. What is silver doing? What are miners doing? What is the gold to silver ratio doing? What is volatility doing? If gold dips but related markets don't confirm weakness, you're likely watching a paper-only flush. If everything breaks together, the tape is saying risk off deleveraging, and you respect it. And that's where the real pressure starts, because the market will reveal itself in the confirmation, not in the initial move. Now, let's talk about the level. The market loves levels because humans love levels, but the real reason levels matter is mechanical. That's where forced decisions concentrate. Systematic funds set triggers around prior highs, prior lows, and moving averages. Dealers' hedging sensitivity clusters around option strikes. Traders place stops around obvious lines. So a dip into $2,840 is not just a number. It's a decision zone. And here's how you treat it like a professional. You define what price behavior at and around that zone implies, and you define what would invalidate your thesis. Because if this is a flush, you expect to see absorption. Absorption looks like this. The dip hits, sells accelerate briefly, then the tape changes. You see lower follow-through. You see bid support rebuilding. You see the market struggling to make new lows, even as bad news circulates. You see spreads stabilize. You see physical quotes stop softening. In that case, $2,940 becomes a pivot, not a grave. But if the market is not absorbing, it will tell you. It will break clean, hold below, and fail to reclaim the level on retests. It will turn that prior support into a ceiling. And if that happens, the math changes. Because systematic selling can accelerate, and leveraged longs can become forced sellers. That's the difference between noise and trend. Trend is what holds after the bounce attempt fails. Noise is what happens inside the flush. So let's put concrete structure on it without pretending we know the future. If you're using the $2,140 reference, the first thing to watch is whether price can reclaim the prior intraday breakdown zone quickly. Call it the 2,850s to 2,860s area. A quick reclaim suggests the flush did its job and the market is resetting higher. Then you watch the next overhead supply zone, the area where the flush started. If price can retake that region and hold, the market is telling you the dip was flow-driven. On the downside, if $2,840 fails and the market can't reclaim it within a day or two of attempts, the next natural magnets become the prior consolidation zones below, levels where volume built before the most recent rally. Those zones tend to catch price because they're where positioning is anchored. If those zones fail too, then you're not watching a flush. You're watching a regime shift in the short term. And that's where the real pressure starts, because it forces even believers to reduce exposure for risk reasons, not narrative reasons. Now here's the two-scenario lens you need so you don't get emotionally hijacked. Scenario 1 is the controlled pullback and retest. In this scenario, the paper flush is primarily a flow event: index rebalancing, thin liquidity, hedging dynamics, profit taking. Price dips, shakes out week longs, then stabilizes as real demand shows up and as forced flows clear. The tell here is stabilization in spreads and physical pricing. You may still get volatility, you may still get intraday spikes down, but the trend structure holds: higher lows on a daily basis, quick recoveries, and failed attempts to break key pivots. Scenario 2 is the continuation squeeze: down first, then up, or continuation breakdown depending on who gets forced. If the market is overlevered on one side, you can get a cascade. If longs are too crowded and margin pressure hits, price can gap down through levels and dealers' hedging can amplify it. Alternatively, if shorts get too confident pressing a rebalancing dip while physical tightness persists, the unwind can turn into a squeeze higher. The dip fails, price snaps back, and the scramble to cover fuels continuation. In either scenario, the risk is the same: gaps, slippage, and emotional mistakes. Because volatility is the weapon the market uses against you, but that's not the part that matters. The part that matters is how you protect your decision-making when the weapon is in play. Here's your viewer psychology shield, and I want you to take it seriously because this is where most people lose money even when their thesis is right. The market doesn't have to beat your analysis. It only has to beat your behavior. It does that by creating urgency. It does that by making you feel late when price rallies and unsafe when price dips. It does that by turning normal volatility into a personal insult. So here's the rule: separate trend signal from noise. Trend signal is what holds on the close and what persists through retests. Noise is the intraday spike designed to collect stops and trigger emotion. If your time frame is weeks or months, then a one-day flush is often noise, unless it breaks and holds below structural levels for multiple sessions. And that's why you don't make big decisions on the first candle. You let the market show you whether that candle is being validated. You watch the retest. You watch whether sellers can follow through. You watch whether buyers are defending with real size. And you keep your sizing in a place where you can survive being wrong without being forced out. Because being forced out is the only way the market can guarantee you lose. Volatility is how it manufactures forced outcomes. Now, let's bring it back to the physical versus paper tension, because this is the core of your title. When dealers refuse to sell into a paper dip, you're seeing a mismatch in incentives. Paper traders can sell first and ask questions later. Physical desks must ask questions first because they can't instantly replace inventory. If the supply chain is even slightly stressed, refining capacity, logistics, bar availability, vault allocations, dealers become conservative. That conservatism shows up in premiums and availability. And when you see that alongside a dip that S conveniently timed with a known calendar flow window, you should immediately suspect you're watching a liquidity event, not a fundamental collapse in demand. But you also respect the possibility that the dip becomes self-fulfilling if it breaks structure and triggers systematic selling. That's why we don't marry a narrative. We watch the proof stack. So what comes next? Over the next week or two? First, the calendar pressure needs to clear. Forced rebalancing flows don't last forever. They are concentrated. That means the tape you see today can be distorted by execution, and the tape you see after the window can reveal the real hand. Second, watch the macro calendar. Even a structurally bullish gold market can wobble into key data prints that shift rate expectations. That's where you get the sharpest fakeouts because liquidity providers back away and hedgers become frantic. Third, watch the curve and the spreads. If the front end stays firm and the curve doesn't relax despite a paper dip, that is a loud signal that physical availability is not loose. Fourth, watch how price behaves at your pivot level after the first bounce. Anyone can bounce. The question is, can it hold on the next test when emotion is lower and execution is more orderly? If it holds, your flush thesis strengthens. If it fails repeatedly, your risk model takes over and you stop arguing with the tape. And now the concrete checklist, because this is the part most videos never give you. Here asks what confirms the flush thesis. Price reclaims the breakdown zone and holds it into the close. Subsequent dips are shallower. Spreads stabilize or tighten in a way that suggests near-term demand. Physical premiums remain sticky or widen. Volatility spikes, then fades rather than escalates. Related markets stop confirming the downside. Here's what weakens it. Price breaks the pivot level, fails to reclaim it on retests, and closes weak. Spreads loosen in a way that implies no urgency for near-term delivery. Physical premiums compress meaningfully alongside the paper dip. Volatility keeps rising as price falls. Cross-market confirms risk off deleveraging. And here is your invalidation line conceptually. The point at which the market has had enough time to bounce and simply cannot. Because that tells you the selling is not just mechanical, it's dominant. The exact number depends on your feed and contract, but the concept is universal. Failed reclaim after multiple attempts is the market telling you to stop being romantic. Now, one more warning before you get excited or terrified. Even if the bullish thesis is right, price can whip around violently. Gold can be a monster in both directions. It can punish late buyers and early sellers in the same week. It can trade like a safe haven and a risk asset, depending on who is forced. So the goal is not to predict the next candle. The goal is to position with a plan that survives noise and respects structure. That's how you keep trust in yourself, not in the talking heads. And if you're in this market because you're skeptical of institutions, here's the irony. Skepticism without a risk plan turns you into the easiest target. Institutions don't need to convince you with a narrative. They just need you to overreact to volatility. Don't give them that edge. So let yes land the plane with the one metric that most people ignore while obsessing over spot. Watch the relationship between the screen price and the cost of immediate reality. Watch the spreads. Watch the curve. Watch the premium behavior. Because the headline price can be shoved around in thin liquidity with mechanical flows and hedging reflexes, but it can't stay divorced from deliverability forever. If physical truly refuses to validate the dip, the paper market eventually has to reconcile with the cost of supply. And if physical does validate it, if premiums compress and the curve relaxes, then UV learned something equally valuable. The market had real slack, and the flush was not just a shakeout. Either way, you're not guessing. You're measuring. If you're still here, you're not here for the dopamine hit of a prediction. You're here for mechanics, and that puts you in a different category of investor. That's the whole point. The crowd gets headlines and emotions. You get structure and checklists. So over the next week, don't watch gold like a fan. Watch it like a risk manager. Track your pivot, track the retest, track the curve, track physical behavior. And when the next spike hits, up or down, remember the only question that matters. Who is being forced, and what does that force them to do next? Because that's where the real pressure starts.